Kevin, great to see you. You heard some of those defensive names that Bob just mentioned. I know there's some overlap in one of your picks. That would be Walmart. Do you agree that it's time to get defensive?
Yeah, I think so. I don't like the word defensive so much. I like the idea of quality. And what we've seen in the last year was a rally off the bottom when all of the lowest quality stocks ran well above the high quality stocks. So I'm talking about companies with a lot of debt. I'm talking about companies with very low profitability. I'm talking about companies that have a lot of volatility in their cash flow streams. Those were the ones that led from, let's say, November of last year through the summer. But things have begun to change, and now these higher quality stocks are holding up much better. So in the last month, when the market has come under this pressure, high quality stocks, as we define it at Washington Crossing, are down only about 1/3 of what low quality stocks are. So we think move up to these higher quality names, you can still get growth, you can still see returns, but the market is going to be more challenged here given all of the risks that we just discussed.
Are we in a correction? Is that what you feel? Is that what it feels like to you?
It very well could be. What we put it in context. Before the pandemic began, we had a market in the United States worth just a little over $30 trillion, which was a pretty rich valuation then. Today, that valuation is a little over $50 trillion, only having come down $1 trillion or so in valuation terms from the high. So we're still looking at a market that's fairly rich that is now going to come into a period where there's going to be less robust policy support. And you throw on top of that some question marks, I guess, about the growth outlook. Our position at Washington Crossing has been to lighten up on riskier assets, lighten up on stocks relative to bonds. We've done this over the last 4 months or so in our tactical asset allocation portfolios, by the way. And we think that we might be in for a period of backing and filling as the market digests what has been a historic run in terms of valuation creation.
Speaking of valuation appreciation, it looks like we're getting at least a little bit of a tech reset, if not a correction here. But every time we have this debate about growth versus value, it always seems that growth in the end ends up winning, at least in recent history. Is it dangerous to walk away from tech right now?
Yeah, we just wrote a piece a week or so ago on our website, WashingtonCrossingAdvisors.com, where we said, what is the most important thing? Now, we're value investors, but even as value investors, in the long run, it really is about growth. Technology has been that sector that has been able to deliver the most consistent growth. And by the way, that sector has virtually no debt associated with it. So if you were to adjust all the sector's valuations by throwing debt on all of the other sectors, and then ask yourself the question, what is the valuation disparity? Tech wouldn't seem nearly as rich, relatively speaking, once you add the debt, because there is no debt for tech. So overall, I think that technology is going to ultimately get back on its feet. We're going to see growth there. But for the time being, we're looking at a market that has just gotten to be very expensive. So the higher beta, higher risk things that led us up here are likely to lead us on the way down. So focus on quality and durability and flexibility and all those kind of things. You should do just fine.